All right, so guys, good morning, and you are welcome to our next major topic, which is called business finance, where we look at the financing decision of a finance manager. So we are looking at business finance. You can also call it the financing decision, right? So far, we have learned investment appraisal, where we learned that we need to have a non-current asset carrying out an investment project. We've also learned working capital. So these are the things we need, all right, as a business. Every business needs NCA and CA. You know the things that are in your NCA, tangibles and tangible non-current asset. You know the things that goes on in your current asset. Now we know that you are going to finance this, and most of the time from the accounting equation, we need to finance this from an equity source and or a liability source. So from the equity source, we are looking at the retained earnings and we are looking at the stated capital. All right, so basically that is that. And from those that are stated capital, we will be looking at shares that are issued through a right issue, and we will be looking at the shares that are through market value or market price. All right, sometimes you have to raise money by issuing shares, and sometimes you raise the money by issuing shares to your own existing shareholders. All right. So sometimes if you issue it to your own existing shareholders and you don't take money, it is called bonus issue. But if you are issuing it to your own existing shareholders and you are taking an amount that is lesser than the market value, then it is called a right issue. Or you can also use a full market value. So basically that is that. But bonus issue don't give you money, and that is why we don't consider it as a source of raising funds. Then the liability, we'll be looking at the debts. All right. So all forms of debt, loans, debentures, leases, credits, and all those things. All right. So basically, that is what we are looking at. So a finance manager needs to source money for a project. This is a project. Finance is all about carrying out the project. So it's not easy being a finance manager. It's different from being an accountant. Yeah, accountants record historical figures. Finance is always looking into the future. All right, so that's a very difficult job and needs to be paid well. Yeah, so this is what we're going to do. So first and foremost, let's pick retain earnings. If we want to source money to do a project, then it means that we have to look at ourselves. If you are an individual, ask yourself, how much money have you saved? All right, if you're a company, how much profits have you accumulated? Then that will be a source of money to carry out your project. All right. Then stated capital, we now need to understand. So here we are. All right. So like I always say, and Mr. Krente will always say, you need to get the book, all right, to handle this theoretical aspect. And the theories are examined. And don't use location as kind of an obstacle. I've told you, wherever you are in the world, so far as you get to this number, you have your copy. All right. So that is that. So that is it. So we have the retained earnings aspect. So let's jump to the debt. We'll come back to the equity because there are some calculations to be done at the equity. All right. So that is that. So for debt financing, you can borrow from a short term, a long term, overdraft, just drawing something over and above your balance that you have in the bank for a very short period. All right. So you just take more than, and usually overdraft, when you have relationship with your banks, it become very easier. Like, I mean, you deal with them a lot, you've established a relationship, it become very easy. All right. Because they know you pay. It's a credit system. So if your credit is good, then, I mean, your rating is good, then they will give it to you. Short-term loans, they are just like the overdraft, but it's just that this one takes longer than the overdraft, but still short term. When we say something is short term, it means it's within a year. All right. So that is that. Some people also look at like for 2 years, but I would prefer to look at that like within a year. Then you have a medium term, then you have a long term. All right. That is that. Then we have trade credits when you are buying something on credit that creates a credit payable. So That is that. Leasing, just like you rent here in Africa, especially in Ghana, you rent, and I think it's everywhere. You lease a house, mortgage it, then you'll be paying. All right. So that is that. These are all short term. These are all short term. So when we look at the long terms, you have the bonds, all right, long term debentures. We have the unsecured loan stock, the loans that you take that is not secured on anything. We have the mezzanine finance, that is something, a layer between your normal loan and a subordinating loan. So if you want money in between, you want money to carry out a project, you have equity, you also have debt, but in between is not sufficient. You need something small to push it up. All right. So you take a mezzanine finance, which is a debt instrument to do that. Now, the details of these explanations are given here. Overdraft, short-term loan. And why would somebody use an overdraft against a normal short-term loan? All right. So the theories are there and it is examined. So, I mean, come on. It will be boring to read the theories to you, and I would want you to get it yourself. All right. So that is that. The advantages of overdraft over a loan. Trade credit is explained. Leasing is explained. Long-term sources of finance. Like I said, why will somebody go for a long-term source of finance? Lesser cost, easier availability. All right. And the rest are there. I mean, get the manual. Or if you are watching the video, you can pause it, make a note. All right. Then use it. Okay. It's very, very important. All right. So that is that. We have these long-term debts. We have redeemable, irredeemable. Later on, you see in the WAC videos, these things that I'm describing to you. Now, there are advantages and disadvantages of using a debt, which is very important that you get to understand, because from the point of view of the person who is kind of buying the debt, it is a low risk opportunity. So, for example, if I buy government debt or I buy a treasury bill, for me, it's a low risk, but not in Ghana. Please be careful because our situation has been deemed different. Yeah, be careful. Somebody might think that it's political, but that is what it is, whether political or not. That is what it is now as we are standing. I'm doing this recording because I have suffered for it. So that is it. All right. Even though it is deemed low risk in theory and everywhere, our place is no such situation. All right. But from the point of view of a business, you realize that the debt is cheap, and Modigliani and Miller theory supports that. All right. You see in the next videos of the optimal capital structure, which is also examined. Yeah. Last diet it was. Last two diets it was. All right. So don't jump over it. Every video section that is done here is very important. Take important notes of them and be in them, learn them, you'll be fine. Of course, there is a predictable cash outflow because you know the interest that you will be paying, and there is nothing like shareholdings. So the person doesn't have any control into your company. All right. So that is that. But the disadvantage is that you as the investor, you don't have a say in the business because you owing a debt doesn't owning a debt, all right, does not give you control. You don't vote in the company. But from the company's perspective, the thing is that it is debt and it is risky, financial risk. Also, when you watch the video of optimal capital structure, these things are explained there. All right, and you come to the types of bond. There are so many types of bond. We have deep discount bond, and this is where the situation of my country faces. In Ghana, assuming we want to go for an euro bond, and I think by now you should know an euro bond because it is in the earlier stages of the introduction of financial management. It is a bond that you are going to get, kind of a loan that you are doing that is denominated in the currency other than our own currency. So we Ghanaians are cedi-based economy. Kind of our presentation currency is cedi, but functional currency may differ. Yeah. So if we go to the outside world or the Western world to borrow funds, what happens is that we are going to borrow, let's say, $100,000. The problem is that uh, our credit ratings are so bad because of mismanagement of our economy, which is clear and obvious. It doesn't matter where you belong. That is the reality. Um, you realize that nobody trusts us anymore. In fact, it sounds sometimes political, but even our own citizens don't trust our country anymore. So they are leaving. We read Brain Drain somewhere when I was in senior high school economics class. We read something about brain drain, and it's happening again. It's happening. People are leaving. Every time I go to work, I pass through the American embassy, and I see a lot of people leaving. I ask myself, what is this? Interestingly, what is this? But the truth is that it reflects in our economy. So now that we want $100,000, but we have to give a discount on the $100,000. So let's say we give a discount of 20,000, we will be getting 80,000. So we go elsewhere, going to borrow 100,000 nominal value, but we are giving 80,000. But at the end of, and we will be paying interest. Let's say the interest is 10%. We will be paying interest on the 100,000. Why not the 80,000? It beats imagination. It's because of our own mismanagement. So we will be paying interest on the 100,000. Let's say we took it for 3 years. So we'll be paying $30,000 as interest. Now, not only that, we need to pay the 100,000 at the end of the 3 years again. But we had 80,000. We still need to pay the 100. And unfortunately, what happens is that sometimes this that we have given a discount to get the money, we will be paying the principal, the redemption value of the 100, even at a premium again. So we will be paying a premium of, like, let's say 20,000 premium, meaning that we will be paying back $120,000. But we still receive 80. And even with this 80, the syndicating bank, the bank that led us to go and get the money, would take an extra percentage like 5 to 10%. So if you deduct that, then it means that the money, that the physical money, cash flow, that will step into the coffers of Ghana is even below the 80,000. Yet look at the payments that we are making. So if you don't know, then this is what happened. So don't be happy when you hear in this country that we are going for a loan. Never be happy. And when government keep borrowing, this is what is happening. We are piling up these issues, and the generations will have to be paying for such interest. It's very sad. We need to rise above this situation. And the thing is that borrowing speeds up infrastructure development only if you use the money judiciously. So if we've done a proper NPV of this borrowing and we invest it in a proper project, then we implement this proper project, we will have better returns. It doesn't matter even these costs because we factor all these costs into the NPV analysis. That is that. And these are what we learn. So if you have a minister or a finance minister who hasn't gone through even these basic concepts, then what is going to happen? I personally believe that our nation should have a certified finance analyst or a chartered tax practitioner or a chartered accountant. And I feel like if you are going to handle our economy as a finance person, you need to have all these three because you'll be doing fiscal policy. You'll be doing monetary policy, which is finance, fiscal policy, which is taxation. All right. So that is that. And if you don't have these accountancy qualification, taxation qualification, finance qualification, I don't think you are worth being a minister of finance. Yeah. So that is my position of it. Other than that, and these are the reasons why we suffer because even a profession gives you ethics. Basically, that is that. So that is how deep discount bond works. We have zero coupon bonds, and this is the coupon rate. So we have ones that are zero. Okay. That then we have the hybrid, the one that includes debt and equity at the same time. All right. So get the manual, go through these readings, what attracts the attractions of convertibles and warrants, read them, venture capitalists. We watch these things in TV, on television, that people are giving money to brains that are bringing up a product for an equity stake. So they say sometimes they say, I'll give you $1 million for a 25% equity stake. That is what we call a venture capitalist. All right. They help beginners. All right. So that is that. But they take equity stake. You are supposed to give them an equity stake. All right. Then I explained mezzanine finance earlier. All right. So we are the gap, it fills the gap between senior debt and equity in the company. All right. The factors of choice for influencing the choice for somebody to go for debt instead of equity, you need to take your time and read these things. Then we come to equity financing. This is where there is a little calculation we need to wrap up with. Now, so we have equity financing. Like I said, you may issue shares to raise funds. You may issue shares to raise funds, and you may raise it through a right issue, issuing shares to your existing shareholders at a price that is below the market value. Or you can do a public issue, a market issue. You can actually do it, issue it to the general public, which we call the full market. All right, full market value. So you can give it to your own people, or you can also give it to outsiders. All right. So basically that is that. So you sell the shares, they buy the shares, they become part of the equity ownership of the company. So that is that. So it's either you are using your retained earnings, which is also part of your equity, but those ones are discussed as earlier. Then we have the right issue and the issuing shares to external people. Here we have the placing and the offer for sale, the public offer, the IPOs, initial public offers. All right. And those are things you need to read. It's very, very important. Now, let's look at the right issue. Like I said, you are giving the shares to your existing shareholders at a price below the market value. So it has advantages and disadvantages. But we need to do some little calculation here on the right issue. A little calculation there. Now, how do we calculate the issues of the right issue? Now, we are going to use a concept called the theoretical ex-ref price or ex-right price. All right, the theoretical ex-right price. It is called TEP, the theoretical ex-right price. Now, the formula for doing a TEP is here, but I'm going to demonstrate it so that you will see, then I'll bring you back to the formula. And I'm going to use the illustration one to do it. But look at the formula. The market value of shares already in issue plus the proceeds of the new share divided by the total number of shares after the right issue. Now look at this. This is how we demonstrate it. Now look at this illustration of Barbell. Now it says that Barbell has in issue 2 million shares, having a current market value of 2.7 each. And he makes a right issue of 1 new share for every 2 existing shares at the price of 2.1. All right. So we are going to do this thing in 2 ways. You pick the one that is favorable for you. I'll recommend one though. You see this statement. It says that they make a right issue of 1 new share for every 2 existing. So it means that before you can have the 1 new share, you need to have 2 already existing. So you need to have the 2 before you can have the 1. The 2 are the O shares, and their value immediately, and the word immediately is important. The value immediately before the right issue they did was 2.7. And the right issue price is 2.1. Now, You see, if you understand what a right issue is, you know that per definition is issuing shares to your existing shareholders at a price that is below the market value. So there is no way this figure should be higher than this figure, because the right issue should always be what? Below. All right. So if you are confused which one to use, that's your clue. All right. The price should rather be lower than the existing price. All right. So we do the multiplication. Here, what will we have? So I think it's with 5.4, right? Yeah. Then here will be 2.1. So if you total this side, you have 7.5. If you total the shares after everything, you have 3. So the TEP is 7.5 divided by 3. All right. So that is that. And that will give you the 2.5. So the formula that says that the market value of shares already in issue. So this is the market value of the shares that they were already having. This is the proceeds that are scammed. So you have this together. Then the one beneath that says number of shares after the right issues. So here we have 2. We did the right issue with 1, and total we have 3. All right. So that is how you do it. Now somebody will say that, but said there's a 2 million shares in the question. Of course, you can use that, which says that they have 2 million shares, which was priced at 2.7, giving you 5.4 million. That is it. And they said that for every 2 shares that you have, you will get an extra one. So if I had 2 million already, for every 2 inside this 2 million, I'll get an extra one. And that is also 1 million. So at the end of the day, here will be 3 million. The 1 million was priced at 2.1. which will give me 2.1 million. It gives me 7.5 million. So back to the same thing. 7.5 million divided by 3 million. And that is also 2.5. So that is that. That is how you calculate your theoretical XY price. Now, what is the meaning of the theoretical XY price? Now, let me give you a typical illustration, and I know you know of it. When you are passing through the street, you see filling stations, and filling stations have their board. All right, you see on their totems that they have placed a price on a diesel, this super, this. All right, that's the petrol. Okay, so now what you should understand is that that price is called the X-ref price, the X factory price. It is a price outside the factory. All right. So that is that. So we are saying that if we do a theoretical X-ref price, if we do a right issue, after the right issue, the price of our shares, all right, the price of our shares will be 2.5. It will move from 2.7 to 2.5 because there has been a right issue. That is the meaning. All right. So now it means that by the end of the year or the end of the period, share prices are 2.5. It means that if you were a shareholder, your value used to be 5.4 when the share you had 2 million and the share price was 2.7. Now that you've taken the right issue and your shares are now 3 million, your value will now be at 2.5. And let's say, let me see, so 2.5 by 3, that means that you have 7.5 million. But you see, this 7.5 million that you have, you bought the 1 million at a price of 2.1, right? So if there are 1 million that came, you bought it at a price of 2.1, meaning that you are going to pay 2.1 million. And if I take 2.1 out of it, 2.1 out of it, it means that your value come back to 5.4. So what you realize is that your value doesn't change. So your worth in terms of your money value in the company, it doesn't change. But what changes? What changes is the number of your shares. You used to have 2 million, but now you have 3 million. That is what happened. All right. So basically that is that. So your value does not change, but your shareholdings change. Shareholdings gives you voting percentages. So if we gave it to everybody, you realize that the percentages are the same. So that your holdings does not change. All right, because everybody took it, your holdings will not change, but your shares will increase. So basically, that is that. Holdings doesn't change, worth doesn't change, your shares rather change. All right. So basically, that is that. Now, there is another example, and I want you to take a look at it. This is for ABC. ABC, what happens? So they announced 2 for 5 right issue at 2 cedis. 2 for 5 right issue. What does it mean? It means that we will give you 2 if you have 5. So the same analogy, 5, you must have 5 before you can get the 2. What is the value of the price? The value of the price, the value of the 5 before giving out the 2. It says that currently they have 10 million shares and the current market value is 2.7. So between 2 and 2.7, clearly, like I've said, you know the one that is beneath should be the one that is lower. If you don't really understand the thing at all, at least that's why you should grab that. And so here will be what? Is 2.7 multiplied by 5. That gives me 13.5. And I know this is 4. So total I have 17.5. Here is 7. My TEP is 17.5 divided by 7. And that is also 2.5. Interesting. So that is that. That is how we calculate our TEP. So it's 2.5 cedis per share. That's it. All right. If you want to use the other way around, it says that they already had 10 million shares, which was priced at 2.7. So that is 27 million. Then they said that for every 5 you have, you get 2. So if I had 10 and for every 5 I'll get 2, then it means that I'll get 4 million. And that 4 million is now priced at 2. So here will be 8. So this gives me 35, right? And this gives me 14 million. So 35 million divided by 14 million will be what? 35 divided by 14. The same 2.5. So depending on how you want to go with it, that is that. All right. So that is it. You go through it. And now we come to the value of a right. Now, the value of a right is just the theoretical XREF price minus the right issue price. So that is it. Value of a right, VOR. VOR is this. The theoretical XREF price that you did. In this case, we had 2.5 minus the right issue price. So if we look at the example that is just here, we will say TEP was 2.5 minus the right issue price of 2. So our VOR is 0.5. That's it. If you do the other one, what will it be? The barbell example. This is the barbell example, right? Yeah. So it will be 2.5 minus what? Yeah, you are right. 2.1. That gives you 0.4. All right. So that is how you calculate the value of a right. What is the value of a right? It means that if I'm going to sell the shares to the public, if I took the right and I'm going to sell it, the value now is 0.4. That is the right part only, not the entire shares, the right that you took. All right. Then we have the value of a right per existing share. So that is also the VOR divided by the shares you needed to be able to obtain the right issue. So that is it, the theoretical XREF price minus that. So this is the VOR you've done divided by the number of shares you needed to have the right issue. So in this particular case, we have the value of a right to be 0.4, right? Divided by how many shares did we need to have this right? We needed 2 shares. The word is per existing shares. We needed 2 shares to be able to have the right. So here it means that value of a right per existing share is 0.2. Can you do that for the ABC question? This is the ABC question. You had your value of a right to be what? 0.5. So what is the value of a right per existing share? Of course, is divided by 5. So that will be what? 0.5 divided by 5. That is 0.1. So that is the value of a right per existing share. So that's all. You get it, right? Yeah, so you have an illustration 4 to work with, and I'm sure you'll be able to find it. The guy has 100,000 in issue, which is 1 CD, which have a market price on 1st September to be 2.10. The company decides to make a right issue offer and offers to its shareholders to subscribe for 1 new share at a price of 1 CD for every 4 already held. So if you have 4, you get 1. After the announcement, the share price fell to 1.95. But by the time just prior to the issue was made, it was recovered to 2. So would you remember the concept that I said that you are going to use the price immediately before the right issue? You see, there is 2.1 here. There is 1.5 here. There's 1.9 here. There's 2. So if you are going to do the step, of course, you need to have an existing share. So already, so what will it be? They say you need to have 4 before you can have 1. Now, this 4 will be priced at the price immediately before the right issue. So they just said that just prior to it, it was 2. Then the right issue is at 1.5. That's all. So the rest is story. So here will be 8. Here will be 1.5. So you have 9.5 divided by 5. Then 9. So when you do that, so this is where you are. So now the caveat, you must be careful. It is the one immediately before, right? Because that is the market price. And this thing is done in IAS 33. All right. So if you have done a file before, it shouldn't be a problem. All right. So that is that. So if I say calculate the value of a right, what will you say? So this one gives us 1.9, right? The value of a right, viewer, yes, 1.9 minus 1.5. That is 0.4. What about the value of a right per existing share? To be 0.4 over 4, and that proves to be 0.1, right? That is that. All right. That is all. Now, we have a past question to deal with. So let's look at the past question. It says that Legri Bank, Ghana, generates a profit after tax of 15. So profit after tax is 15% of shareholders' fund. Part is 15% of shareholders fund. Now, what is a shareholders fund? Shareholders fund simply means the equity side of your balance sheet. Those are the part of your balance sheet that are generated by the shareholders. So stated capital, retained earnings, reserves, all the reserves. Means preference share is not part because those are not ordinary people, right? Okay. So that is that. That is, so we have this, the ordinary shares, then we have the reserves. Okay. It says that the management with board approval wishes to raise 50,000, okay, from a right issue. All right, that is fine. To expand their existing operations in the country. The return on the shareholders fund will not change, so it will still be 15%. The current SDIP market price is 4. It means that the shares that they have now is sold at 4. The right issue price proposed is 3.8. Calculate the total number of shares to be raised by the total number of shares to be issued by the company. So if they want to raise 50 million through a right issue, and the price of a right issue is 3.8, then the share determination is not difficult. Because I want to raise 50 million cedis. And the price is at 4 or 3.8 for through a right issue. Then it means that if I want the shares, it will be just 50 million divided by 3.8 cedis. So I'll get for every share. All right. So how many shares? 50 1, 2, 3, 1, 2, 3, divided by 3.8. Meaning that the number of shares I should issue to get the 50 million and to be sold at 3.8 is 131,578,950. It is shares, so 0.74 has to be rounded. There is no point in shares. So here, 1, 2, 3. So it means that I need to issue 13,157,895 shares at a price of 3.8 to be able to obtain the 50 million. That is that. Now, immediately I do that. So this is the first part of the question. That is it. So 3 marks free of charge. Then it says that I should determine the theoretical XREF price per share after the issue. So do you remember what we do with the theoretical XREF price? The old shares that was there, multiply by the amount, the share price, and the new shares. This is the new share. So old, they have 40,000. The price of this 40,000 is 4, which means that the same way I did this, I can know the number of shares. So if I do 40 million, divided by 4, that means that I'll have 10 million shares. So it means they had 10 million shares, which has a price of 4. That's why they have 40,000. So it means that old shares is 10 million shares. And I can strike the ratio for that if I want, which is priced at 4 to give 40 million Ghana cedis. Then right issue was 13,157,895 at a price of 3.8. All right, to raise a 50 million. So at the end of the day, here is 90 million. Here should be 23,157,895. Then my theoretical XREF price will be 90 million divided by 23,157,895. So what do I have? 90, 1, 2, 3, 1, 2, 3, divided by 23,157,895. And that gives me 3.8863, blah, blah, blah. So this, since it is money to 2 decimal places, so it will be 3.89 per share. So that's my theoretical XREF price. And it says that calculate the new earnings per share. So this is a bit of IAS 33 and of course ratios. So the formula for earnings per share, you see, is earnings. Earnings means profit. So profit after tax, but it must be those ones that are available for the the ordinary share people only. So I need to take any preference share dividend. Then I will divide it by the number of shares. It's actually the weighted average number of shares. So here, what is the profit? Of course, there's no preference share. The profit they said is 15% of what? 15% of the shareholders fund. So now our shareholders fund is this 90,000 after the right issue, but there is also a reserve of 80, right? It is constant. So here it means I'll have 170 million. So if I do 15% of my 170 million, what will I get? 170 by 0.15. That gives me 25.5 million. So that is it. So my profit after tax is 25.5 million cedis. But my new shares after the right issue was 23 after the right issue was done. So 23,157,895. So that is basically what I have now. So if I do 25,500, 1, 2, 3, divided by 23, 157,895. I have 1.1. So basically, that is that. So that's the earnings per share. And it says that the last question says something. Comment on the calculation of the theoretical express price in II above. Yeah, so the calculation of the theoretical express price is 8.9. So it means that before the theoretical express price, our shares was 4. The issue of the right issue has caused the existing share price to now be 3.89 at the end of the year. So every shareholder will be valued at 3.89. So basically, that is that. You do this, you have your 10 marks. Easy peasy. There you go. All right. So that is that. So let's wrap up. So these are your solutions. Okay. You have it exactly the same. You go around it. Now, the last thing we are going to do is to determine the shareholders option towards a right issue. Because if a right issue is done, there are 4 choices a shareholder has. Choice number 1 is that he can exercise the right issue. I mean, he takes the right issue. Somebody can also decide to say, I will not take the right issue, sell it to the public. Sell the right issue shares to the public. Don't give it to me. Or I will take it and instead of paying, I'll sell it to the public, get the money and come and pay. So it's called renunciation. Some too can say, I'll take part so my shares will increase and I will sell part. Then someone can also decide to say, I'm not interested. There's nothing I want to do. Let it slide. That is it. Let's look at the effect of these decisions on the shareholders mathematically. So we take a question to look at it. So read the theory, but the calculations will explain it more to you. So let's look at this particular question to do the explanation. We have Alpha Company has issued share capital of 100 million shares with a current market value of 0.85 each. It announces 1 for 2 right issue, meaning that if you have 2, you will get 1. All right. 1 for 2 right issue. It is not always like every time that the low, it can be 5 for 2 right issue, meaning that if you have 2, you will have 5. All right. And this right issue is at the price of 40 pesos per share. It therefore plans to raise 20 million in new funds by issuing 50 million new shares. So it's raising 20 million cedis by issuing out 50 million new shares. Now, of course, if you multiply the 50 million by the right issue price of 4, you should get the 20 million. Now, we are supposed to calculate the theoretical express price. And for a shareholder B holding 1,000 shares in Alpha, we should consider his wealth if he takes up his rights, sells his right, buys 200 shares, and sells the right to a further 300, or take no action. So let's look at it. So first of all, let's do our theoretical express price and also calculate the VOR. So TEP, what do we have? Before the right issue, the TEP price. So you need to have 2 to get 1, right? And the price is 0.85. And this one is also at 0.40. So what will be the figures that we will have? 0.85 multiplied by 2, that gives 1.7. And this one will be 0.40. So at the end of the day, it will be 2.10, and you have here 3. So your TEP is 2.1 over 3. That is 0.7, right? Yeah. So that is it. That's the TEP. Now, what is the value of a right? We need to do that. The value of a right, therefore, is equal to, because if you don't take the right and you are selling it, you are going to sell it at its value. So 0.70 minus 0.40, that is 0.30. So that is the value of a right. So if you are going to sell the right, the value of that right is 0.30. All right. So that is that. Now, let's look at the decisions. So decision 1, bear in mind that already he has 1,000 shares. Before the right issue, he has always been having 1,000 shares, and his 1,000 shares before the right issue is priced at 0.85, meaning his worth is 850, right? You multiply, that's 850 cedis. That is it. Now, if he takes the right, what is going to happen? If he takes the right, how many shares is the right? Because they says that for every 2, you get 1. He had 1,000. So for every 2 he has in there, he's going to get 1. That gives him 500 shares. So taking the right is going to give him 500 shares. And the right is sold at, if you are taking it, you'll be paying 0.4 for it. It's not free. You'll be paying 0.4. That's the price of the right. So now, let's look at the position of this guy. So it means that at the end of the year, he has 1,005 shares, right? At the end of the year, he has 1,005 shares, which will be priced at the end of the year. Price of a share is what? Good. That's the reason why you calculate the TEP, which means that is going to price at 0.7. And how much is that? So 0.7 by 1,005 gives me 1,050. But hold on, he paid money for the 500 that he took. How much did he pay? So the cost of that 500 is at 0.4, right? That is the cost. If you were, that is it. He paid 1, because for the extra 500, it's not free. You take it by paying, and that means he's paying 200 at the cost. So at the end of the day, his value is 1,850, but his number of shares he has is now the 1,005. So what happens to this person? Value doesn't change, his wealth doesn't change, but his shares increases. Holding is the same, but shares has increased. Value is the same. All right. So let's look at the other person. Of course, if he sells the right, which means that he won't take it. It means at the end of the year already, before all these things, this is what he has. Which means the 500 extra, he won't take it. He will sell it. And if it is a right, this 500 is not the shares, it's a right issue share, whose value when he is selling it into will be the VOR, the value of the right. He will sell it at 3. And that is 0.3, sorry. So 500 by 0.3 is 150. That is it. So he sold it. But at the end of the year, he still has 1,000. So at the end of the year, his shares won't be 1,005 because he sold it. So he has his existing 1,000. But everybody's shares price, the existing that you had, is no more at 4. It will now be at the TEP price, which is 0.7, which means that you have 700. So if he sells the right, again, his value is the same and his shares too is the same, 1,000. It didn't change to 1,005 because he didn't take it. He sold it. It will not be there with him at the end of the year. So that is what you see. Let's see if he buys 200. If he buys 200, he's going to buy the 200 at what price? 0.4. That was the right issue price, which means he's going to pay 0.4 by 200 is 80, the cost. And if he's selling the 300, it will be sold at the value of a right. So that is 0.3, and that is also 90. That is the gain. At the end of the year, how many shares does he have? Which is going to be priced at the TEP price. How many shares? How many shares? 1,003. That's good because he buys 1,002. Yeah, because he bought the 2 in addition to his 1,000, and that will be priced at the TEP price of 0.7. So 1,002 shares, 0.7, 840. So at the end of the day, it's still 850. He hasn't changed, but his shares has moved from 1,000 to 1,002. So basically, that is that. The last one, do nothing. If you don't do anything, the shares will be sold to everybody. But you at the end of the year, you still have your 1,000 shares, which will be priced at the TEP price, and you have 700, meaning that initially that you had 850, you lose 150. So taking no action in situation is costly. Taking no action to learn your ICA is costly. Even watching this video, not sharing with a friend is costly to your friend. So share the video. Let them subscribe. Let them also pass their CA. Because you see, I get it. The human psychology is that you are happy when your friend is suffering. It's a human psychology. Yeah. Because when your friend is suffering, you are in the position to provide help. That is where your happiness is from. When your friend is going up ahead of you, it's very annoying. It's human psychology. Watch this movie, Three Idiots. You understand what I'm talking about. They are friends that love themselves. But when the two guys realize that the friends that they play with a lot is rather the best student in the class, the whole school, it's rather sad. Yeah, so, but you need to beat that concept, all right, by causing everybody to pass, all right, causing everybody to do well. So share the video. Don't take it or don't watch it alone. All right, so do something, take action, watch the video, learn the video, share the video. All right, so these are the processes you go through, and that will be it. All right. There is this past question, ACCA past question. Probably we can take a look at that to end the class. All right. So we have Laforge Company, which is a listed company which designs and manufactures air conditioning units, which are then sold through third-party retailers and distributors. Economic growth in a number of Asian countries have increased the demand for its product, and Laforge wishes to target this market in order to generate sales and profit growth. So all these things you read is just a prelim. Let's get to where the proper issue is. It says that to target this market, Laforge needs a new machinery, which will require an investment of 25.48 million. All right. Now, two options are available to him. Of course, there's a right issue, and the right issue is at a discount on the current share price of 2.6. So you see, it means the right issue price is 0.7 of this 2.6 because you'll be given a discount. So the market value will be the 2.6, then the right issue price will be 70% of this 2.6. Or they will do a 6% issue loan note redeemable at nominal value 100 cedis in 10 years time. Then they have P ratio of 11 times. Of course, you will not understand P ratio by now unless you have watched the business valuation. All right, so there's a little element of business valuation in this question. Probably this is an exam question. It's assumed that you have learned everything. All right, so that's why the question is like that. So I'm going to focus on the right issue part, but I mean, I'll relax more. Even though I'll do it, I'll relax more on the loan notes part. Okay, and what you do with the P ratio is for valuing a business. The extract of Laforge's most recent financial statement shows that profit from operation is 25.5. And if you know your FR well, which means profit from operation is gross profit minus operating expenses. So that is it. You know, when you get your gross profit, you less your operating expenses. And according to IAS 1, there are three major operating expenses, which is selling and distribution, admin, and research expenses. So it means you take away all these things and you get what we call operating profit. All right. So that is that, operating profit. It's also called profit before interest and tax. All right. So what we call, when you are doing your ROCE, remember when we're doing the ARR ROCE, is you get your profit before interest and tax and you divide it by the capital employed. So this is what we call operating profit. After this, according to IAS 1, you need to less finance cost, which is all forms of interest, and you will add investment income. All right, so you less this, you add this, then you get your profits before tax. Then you now tax, then you get your profit after tax. So that is basically what they are showing us. So they are telling us that this side is 25.5 and profit after tax here is 16.56. That tells you that there is a finance cost which has reduced this figure to this. Because if it were to be an investment income, it will rather increase the figure. So what is the difference? 25.5 minus 16.56. That tells you that there is this there is a kind of this is profit after tax. So it means that then it means this question you need to be very, very careful. So is the profit after tax rather that is here. So profit after tax is 16.56. Which means that we need to tax the, and let's read the question in the entirety and see. It said that without a new investment, the forecast profit from operation for the coming year is expected to be the same. So if they don't do the project, this one operating profit will be the same. All right. Now it says that if the investment is undertaken, the forecast profit from operation for the coming year is expected to increase by 4.5. Okay. So if they do the work, this figure will increase by 4.5. If you add it to this, that's like 30, right? And they said that he pays a tax of 20%. Good. So it means that there is a figure that is supposed to be here, and you pay a tax, you calculate your tax on it, and you can get your 16.5. So if tax is 20%, it means that this figure is 80%. So if I gross it up and say 16.56 divided by 0.80, that's the 80%. That tells me that the profit before the tax is 20.7. So if I do 20% on that, that tells me that the tax is 4.14 for this one. And that is what will give me this. And if this is the case, then it means what will be the figure here? Finance cost figure here. All right. So the 25.5 minus 20.7, which means that there is an existing finance cost of 4.8. All right. So basically that is that. So the investment income, if they do the project, the investment income is going to increase this figure. So that is the 4.5. They will earn something and it's going to increase the figure. So that is that. So, but what are the requirements of the question? It says that for the right issue, if they are going to raise the fund through right issue, we should calculate the theoretical SREF price and the value of the right. Simple. What are the number of shares they have already? This is it. We can pick it out from here. So that tells you that if they sold some shares to have this figure, X, which is sold at 0.50, is giving 35. So what is X? So let's find X. So that will be if I look at this, I will say 70 because 0.5 is half. So it's 35 divided by 0.5, and that is 70. So it means we have 70 million shares, which is priced at 0.5, and that is giving the 35 million. So basically, that is that. And the right issue amount, they say that, so what does this mean? It means that this gives me the shares. So it means that already the number of shares should be 70 million. If I'm doing my theoretical exercise, it should be 70 million, and the market price for that is 2.6 according to the question. So that, then they said that the right issue, we want to raise, how much do we need? We want to raise 25. So we want to raise 25.48, and this one is 70% of this because they give a discount of 30. So 2.6 by 0.7 tells me the right issue price is 1.82. And here, so that 2.6 by 70 million gave what? 182 million. 182. Everything here supposed to be in million. So what will be the shares here? Of course, the same way, 25.48 divided by 1.82 gives me 40 million shares. So it means my TEP will be 84 here, and here will be what? So 25.48 plus 182 gives 207.48. All right. So what is TEP? I just need to divide this by 84. So divided by 84, and that gives me 2.47. So that is it. So sometimes you don't expect the examiner to make certain things easy. You have to crack small. All right. You know what you need, find them systematically, and you'll be fine. Now that you've gone through this illustration, I think that if you get a similar one, you can work around it. Now, so they said we should also calculate the VOR. So VOR will be 2.47 minus 1.82, right? 1.82. How many marks are we getting from this? This gives me 0.65 cedis per share. How many marks do we get from these two? 3 marks. At least you've done something. And it's saying that assuming the share price goes ahead, the investment goes ahead, calculate Laforge forecast earnings per share. So we did earnings per share before. So profit after tax minus the preference shares, I divided by the preference shares. And the resulting share price, so that's why they gave us the P ratio, right? Oh, okay. So that is that. So the P ratio thing, you understand it more when you actually do business valuation. All right. So if he uses the right issue, what is going to happen? I think that I'm going to use what we did here. So already, this is the profit after tax. So currently, this is it. Currently, this is it. So the earnings per share from this, all right, will be this divided by how many shares were they having before the new issue? 70 million shares, right? So it means that when I do 16.56 divided by 70 million shares, what they have is 0.23. So I'll round it up and say earnings per share is 0.24. And when you want to know the shares, when you have earnings per share and you have what we call the P ratio, all that you need to multiply it by is the P ratio. And the P ratio is giving us 11. So multiply by 11. So it means that the share price after everything will be 2.60. All right. So you just multiply. So if I am to arrange this thing systematically, this is what I would do. Currently, I'll do currently, and we have the right issue, and we have the loan if they are going via the loan. So I know that my profit before interest and tax is 25. Oh, sorry. What do we have? Yeah, 25.5. And there was a finance cost component we found out, and that was 4.8. Let's confirm. 4.8. So we had 20.7, right? So he gave us 20.7. That is profit before tax. And we taxed at 20%. And so what did we get when we taxed at 20%? 4.14. 4.14. And that's how come we had profit after tax to be 16.56. And the shares before the right issue is 70 million shares. All these things are also in millions, don't forget. So it means earnings per share, which is 16.56 divided by 70 million is what I did. And I had 0.24. And we were given P ratio of 11, which means that the market price per share, the formula is PE ratio multiplied by EPS. You understand it more when you do the business valuation. And when I do that, we now had 2.60. So the question said we should do that for the two situations. These two situations, when the loan note is done and when the right issue is done. Now the right issue done means that the project went forth. So they said that this figure will increase by 4.5, right? So it makes here 30. So if you do the project by doing the right issue, you get it. If you also do the project by the loan, at the end of the day, you use the loan to raise the fund. And already there is an existing finance cost here. But this one, since they are going to do the loan, they will get an extra finance cost because there's an extra interest they need to pay. The loan is 6%. The money is 6.25. So 0.06 multiplied by 25.48 is an interest they will pay. Additional interest of 1.5. So 1.5288. So this is that. This is that. So if I add it to the 4.8 that they have, 4.8 that they have already, it means that they are going to have 6. So you are going to have, so it is 4.8 existing plus 0.6% of 25.48, right? Yeah. So in total, I have 6.3288. You can round it up to 33. All right, that is that. Now, so what will we be having? Minus 30. This one is giving me 23.6712. Like I said, you can round it. And how much would this one be? 30 minus 4.8. Because that one, it was already there. So you have 25.2. You pay tax of 20%. So tax will be 5.04. And this one, 23. Let me do this part first. 25.20 minus the tax is giving me 20.16. If they do the share right issue, what is the number, the new number of shares? 84 million. So this answer divided by 84 million gives us 0.24 also. All right, so it gives 0.24 also. All right, so basically that is that. So 20.1684 gives 0.24. Then multiply by 11. Multiply by 11 is it will be the same, right? Because this one was 16.56 divided by 70. And it was also like that when rounded. So it means here too will be the 20.16 divided by 84. I had 0.24. So multiply by 11 also is the same. Yes, 2.64. A little change. But how come? Let me see. 16.56 divided by 70. That is 0.236 blah 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 multiplied by 11. And that is 0.26. Okay, that is why. Yeah, so a little change. So it's 0.23 something. All right. So I think it's best you keep the figure on your calculator you punch. Then the tax here is 0.2 multiplied by 23.6712. That is 4.73424. And what is the profit after tax? Minus 23.6712. That is 18.9369. I mean, you can round into 94. Here, what will be the number of shares? There was no right issue, so it means the shares will still be 70. So if I divide this by 70, I have 0.27. All right, 270 something, but just round. Multiplying this thing by 11, that is 2.98. So this is what you are going to do. All right, so basically that is that. All right, so that is it. We round up here because there are some theoretical aspects to be done. So this is what we did. The question also says that we should discuss the method of financing, and this is where I tell you to get the book, all right, and recommend which one. So there are so many types of financing. We have the right issue, we have the IPO, we have the placing offer, all right. And the effect is that you see clearly that the question also made mention of dividend. All right. I think the D part. They said at a recent board meeting discussing the financing option, one of the directors suggested reducing the forthcoming dividend. Okay, so they reduce dividend so that they will keep retained earnings. The retained earnings will be more. And he said that in the past years, Laforge consistently pay an annual dividend of 8%. So probably they want to reduce the 0.08 cedis. Each shareholders include both financial institutions and individuals. Now, if you are going to reduce somebody's dividend, it creates what we call the signaling effect. It tells us that something is wrong, but actually they are going to use it to go do an investment. But the person will not see that. All that the person will see is that you are reducing my dividend. It's called the signaling effect. Tell us that something is wrong somewhere. Creates the clientele effect, liquidity preference. Now, this I will ask you to get the book and have a read of that. All right. So that is that. Now, so how do you raise ordinary shares? This is where the IPOs come in. So if you're unquoted, how will you raise it? If you are quoted, how will you raise it? Method of obtaining listing, IPO placing, an introduction, and also that is that. Initial public offer here. So we take this is to deal with the IPO, explain the IPO. All right. So get a read at it, you will be fine. All right. So that is that. All right. So the remaining is reading it. It's all about reading it. Okay. Take your time. Good. Because it's examined and the choice between an IPO and also all these things. So you take a look at this. The advantages of obtaining listing and disadvantages of obtaining listing. Stock split is also explained. Script issue. All right. Script issue is just like the bonus issue. All right. Sometimes do they collect money that makes it a right issue. Then we have preferences. It is also explained. All right. Then you have all these choices to look at. Islamic finance is another one. Yes, learn the principles of Islamic finance. Because when COVID came, everybody was calling out that we should go for Islamic finance. These are the principles. They share profit or losses. There's no interest allowed. Interest is called riba. All right. Now, finance is restricted to Islamic accepted transaction. So if it's not Islamic accepted transaction, they won't give it to you. Gambling is called maise. All right. Then uncertainty in contract, which we call risk, is called gara. All right. Prohibited activities is called haram. I think that one everybody has an idea of it. Then these are their sources of finance. We have the murabah, which is a trade credit. So if you know trade credit, that is murabah. Ijara is lease finance, remember. Sukuk is the debt finance. Then we have the mudaraba, which is equity finance, and the mushraka, which is the venture capital. So that is that. With these synonyms, you are able to explain it, and these are what you see. So take your time. How interest is earned is also there. I mean, this one, I will encourage you to have the book. All right. I think after that, we have tax considerations of how marketability of ordinary shares, the things to consider, tax consideration, cost, lack of information, and all those things. And if you are an SME, how you are going to raise funds sometimes include a business angel, enterprise investment scheme, venture capitalist, yes, and trust. All right. And there is a question for you to deal with. Nice question. You are supposed to calculate the theoretical X-ray price. This is for your rehearsals. And discuss using, calculate and discuss whether using the cash raised by right issue to buy back the bond is likely to be financially acceptable. So I will leave these ones to you so that you use it as a practice. So get the book. The solutions are there to guide you as to whether your answer is correct or wrong. All right. And because you have to, and if you don't, and these things come in the exams, there are likely questions to come in the exams that I've added in the book. No, it's not an ICA pass question. It's yet to be examined. So you'll be ahead. You have similar questions. You can also join our class. All right. So we have two classes. All right. We have the online class, which is under the name UIPD. We have a face-to-face class. So basically, I teach at UIPD, Universal Institute for Professional Development. Of course, I'm also in University of Ghana, but that one is, is public affair. This one is private, the Universal Institute of Professional Development. I also teach with Tema Accountancy Center. All right, that is a face-to-face class. All right, and I'm also with Prof Training Solutions where I teach corporate reporting. All right, and advanced audits with FR. So this one too, I teach here. That is the videos you see, FRCR, advanced tax principles of taxation, financial management, audit and assurance, and advanced audit and assurance. So these are the courses I do for. Some people ask me about man accounting. The book will be released in December. All right, so take note of that. And when we start, this UIPD is in session, so you can join UIPD for MA, you can join PTS for MA, and come to thermal accountancy face-to-face for accounting. All right. In thermal accountancy, my good friend, learned friend, Philip will handle you for management accounting. All right. So that is that. PSA, Mr. Victor is there for TAC. PSA for UIPD is done by my good friend Edmond. All right. So wherever you want to get us, I think this number is available for you. Okay. We also have this number available also at your disposal. Thank you and have a great day. We will meet again, and the next time when we meet, after you've gone through all the questions, you see, these are ICA questions. Calculate the new number of shares to be issued coming from the same TEP analysis. All right, calculate the amount of money raised from the right issue. It's the same. If you look at this, Sobolo Ghana has taken a strategic decision to expand. A new venture has been identified. All these things are English. It says that the right issue will be done at 6 cedis per share with existing shareholders, and it says that existing shareholders will receive 2 rights for each 3 currently held. So it's the same thing we always do, is 3 to get 2. That's it. And it says that the right issue price is what? 6. And this one is what? 8. It says that the company has this outstanding and they are currently trading at 8. And it is asking you to calculate the number of shares. The number of shares will be 5. So if this one, they had 600, if the old was 600, and you are doing, it says that for every 3 you have, you get 2. So you multiply this thing by, so they say for every 3, so divided by 3, multiplied by 2. All right, so let's say 600 shares you had. And they said that 600 for every 3 you have to. It says that 2 right for each 3 currently held. So for every 3 you have 2. This gives 2 multiplied, that gives 400, right? So at the end of the day, they will have 1 million shares. And it says that calculate the amount to be raised from the right issue and the total value of the company after the right issue. So you see, the amount to be raised from the right issue is this 4 million shares that you have gotten, multiplied by 6. That is it. Then it says the total value of the company, it will be the TEP. So after the thing, there's 1 million shares, right? After everything, because this one will give us 400. So 400, after this, there's 1 million shares. And the 1 million shares will now be valued at the TEP price. So if you were to complete this, 3 by 8 is what? See how easily I'm going around this. This is 24. This is 12. So that will make it 36. Here is 5. So 36 divided by 5 is 7.2. So it means that after everything, it will be sold at 7.2. That's 7.2 million. You do this, you get 7 marks. It's very, very easy. This is it. That is that. You do this, you are gone. You are gone. The same, you have explain the benefit of credit ratings to KDB. Credit ratings helps you to know the payability of your money. Like the way I said that Ghana's credit rating is down and we have to incur also such costs. Even the solutions are provided. What are you waiting for? What are you waiting for? 5 factors you consider when determining the types of debt finance to raise. Do you remember it was part of the theory? So what are you waiting for? 10 preemptive issue. Preemptive right. Yes, preemptive is doing something before the thing majorly happens. So those things are also seen. Taking the shares before it is issued. You are taking up the right before it is even given to you. Right, empty. Pre-action. So that is that. Explain the concept of right. We've done all these things. All right. So then we come to our work, and then the next videos will take care of the work. So thank you. Be part of our class. Buy our books. God bless you. Share the video. Subscribe. Bye-bye.